It's been a tough year for the Chinese stock market. In stark contrast to US and global stocks, the CSI 300, an index of top 300 mainland shares, and the Hang Seng Index have fallen sharply from their latest high in January. Chinese companies have also slumped to a fraction of their value 3 years ago. But some investors are sensing an opportunity.
There are a lot of good bargain hunting stocks, mainly because the valuation has been beaten down quite badly by the recent events. There are geopolitical tensions, unfavorable macroeconomic news. And if you look at just look at an index like Hang Seng Index, it's trading at 18,000. The price to earning ratio is about 6.35 times, and I would say this is all-time low. If you look at the key sectors, one of the sectors that you can look for bargain hunting is the domestic tourism sectors. Domestic tourism has actually taken a boom, and you could see that in terms of the tourist intercities tourist numbers, as well as train tickets, air tickets, etc. This is one key area to focus on.
The tech and e-commerce giants are also among a handful of high-quality Chinese stocks that are now undervalued and trading at a discount.
There are the large tech names that are well capitalized, have strong cash flow, but have suffered due to the Chinese crackdown on tech stocks, which began in late 2020. These include names such as Alibaba and Tencent. In both cases, the forward PE multiple is down by a factor of 2/3, which suggests that if you were looking to accumulate stocks that are undervalued, these two names and a number of other major tech names in China would be at an alluring point in their development.
I'm still looking at China technology space and also China consumer space, which I find the most value in finding great companies. The worst I feel is over for Alibaba. They have done their restructuring. Their issue with the government seems to be resolved. The antitrust issue has been settled, and they have a direction, right, which is to try to spin off some of their business unit into separate unit in the future. And I see that as unlocking value for investors. And that's the long-term trend that I feel would add more value to investors in them. And also each of their business still has a large addressable market and a huge runway for them to grow in the future as well.
Another feature of a value investor is what's known as the margin of safety, which is the degree to which the valuation has fallen to such a degree that the stock, in a sense, pays for itself from its cash generation. Many of these names fall into the classic margin of safety category, and it's important for investors to look at these value metrics in a very cashful manner when assessing the value opportunity in China.
Growth stocks have traditionally performed better than value stocks in China. But analysts say investors now have the opportunity to go for both growth and value.
A very interesting trend recently that have played out is you could still get high growth companies, i.e. companies with revenues growing at double digits at very reasonable valuations. I would say there will be a congruence of companies that is hovering between high growth as well as of value, and this is a good opportunity because you are picking up a company that is very strong in growth, at the same time at a very compelling valuations.
Let's take the example of Alibaba and Tencent. These are growth stocks where the earnings are rising, the top line is rising, the EBITDA is on a stronger trajectory. At the same time, it's trading at a sharp discount to the average PE multiple that we've seen over the last decade. So you have a combination of those two factors where you would be able to pick up growth stocks at a discount to their market value or their fair values.
However, the risk for investors who favor cheap stocks is tumbling into a value trap, a term for stocks that look too cheap to ignore but are misleading and stay that way.
We always need to guard against what's known as the value trap. The value trap is when you look at conventional value metrics, such as the discount to the net cash on the balance sheet, such as the degree to which a stock is trading versus its average PE multiple, and invest very heavily on the basis of these value metrics without understanding the larger context, there is a possibility that the stimulus measures may not pan out. There is a possibility that the property collapse could be far more dangerous than the market is accounting for. If so, there is a possibility of a value trap.
There's a lot of companies trading very cheaply in China, and maybe we shouldn't be too tempted, in rushing into, once we find this kind of companies. There are companies, large company giving a dividend of 10% or more. They are trading at 3 or 4 times their earnings, right? But sometimes we have to take a step back and really try to dig out why is investor avoiding these companies. Is there something that we don't know?
Investor optimism in China has dropped to levels not seen since the COVID-19 lockdowns.
There's a possibility that the property debacle could be far worse than expected. There are chances that the government may be averse to stimulus measures. Mind you, the government's fiscal position today is not as robust as it was in 2008, 2009.
The capital market is still pretty much dominated by US and Western firms. So all the fund houses are mostly from the US, and their perception of China really affect the valuation in China as well, very, very drastically. So without the US investor changing their mind about China, it might be very hard for China valuation to shoot up very high. So that's something that as investors, for us to take note of. Maybe we need a little bit of patience, and also understand that just because we start investing in them doesn't mean that those stocks will shoot up straight away, right?
For investors, though, China's growth potential may make it too big to ignore. But analysts emphasize the importance of taking a balanced approach through diversification across sectors as well as markets.
If you believe in China, you have some exposure to them, but I wouldn't go so far as I only invest in China and nothing else. Right? To me, I invest globally, and I see China as a way to diversify my portfolio risk.
My worry is when investors say that look, I only have 3 Chinese stocks, and then over a period of time, you start complaining about them because they're non-performing. You're not likely to get 100% correct. And unfortunately, if 3 of our stocks are in the same sector and they are affected by some kind of policies, you are more likely to get everything wrong. So diversification across sectors, diversifications, across names, making sure that you have a healthy portfolio is very important.